All right, enough about accounts receivable. We've exhausted that receivable. Let's talk about another type of receivable, which is notes receivable. Notes receivable is a receivable that specifically deals with what's called a promissory note. These tend to be loans, so you can kind of think of these as like student loans or mortgages or bank loans or anything like that. So notes receivable is a written promise, again, using a promissory note, to pay a specified amount of money, usually with interest, either on demand or at a defined future date. So again, these come with interest. That's a big difference between accounts receivables and notes receivables. Notes receivable tend to come with interest. Now, there are a couple parts that you need to be aware of. There are multiple parts of a promissory note that make it that are important enough for you to keep up with. One is you have what's called the payee. The payee is the party who is owed. They're the ones that the money is coming to. So when you're dealing with a notes receivable, since you're the one that's being owed, you will be the payee. Then you also have what's called the maker. That's the one who who owes. They're the ones that's paying you. Okay. You have what's called the principal of the note, and that is the amount being loaned and the base amount promised back at a future date. Okay. That's what's given. That's what you have given out, and then that's what you are owed. That's the base. We also know there's another piece to this, because not only are you owed the principal of it, you're also owed the interest side of it too. And so interest rate, that is the amount charged for using the money until the due date. And so it's important to be able to keep those, because the principal is just they're giving your money back. The interest is actually what you earn, so that is a type of revenue for you. So that's why we have to keep those things different. So then we have the maturity date. That's another big piece, because that tells us how long this is going to be. This is the date in which the note must be repaid. Now, it's a couple things I want you to pay attention to when you're looking at problems, because if the time is expressed in days, the maturity date is the number of days after the note's date, so after the first day. So if it happens on January 1st, then you're going to start counting with one day as January 2nd. It's the next day is day number 1. Okay? If the time is expressed in months or years, then the note is due in the month of its maturity on the same day as the original date. So if it's a 3-month note and it's on January 1st, so February, March, April 1st. So it's on the same date, it's just 3 months in advance. So that's how you keep up with those. And in the next videos, I'm going to show you how to do the calculations of those, which is probably even more important. So.